Hello, everyone. It really is a pleasure to be here with you today. It's great to see so many people present, also online, and I'm looking forward to the next 45 minutes. My name is Sanne Zwart, and I will be moderating this session. We have already had many great sessions on a wide range of topics during the last 2 days. What we are going to talk about now is risks. The program specifically mentions systemic risks, which is a quite specific type of risk and very different from, say, systematic risk. And I know that these differences are the kind of stuff that is really exciting some economists. But I would prefer to not start splitting hairs on these definitions and to just talk about big risks to the stability of the financial sector. So risk is the possibility of something happening, often with a focus on the negative. It also involves uncertainty about the effects or implications of an event. And clearly, when COVID hit, we knew it was going to have an overall negative impact on the economy. But how large would the impact be? What would be the channels? Who would be hit most? And who is best prepared to deal with any fallout? In this session, we will try to provide possible answers to these very difficult questions. And we will all be giving these answers based on our own expertise and fields. It might be useful to differentiate already here between two categories of risks: external and domestic. External risks include reduced trade due to global falling demand, lower commodity prices, lower FDI inflows, lower remittances, and closely related to all of this, currency depreciations. Domestic risks obviously concentrate on asset quality and the creditworthiness of economic actors, especially larger ones or specific sectors. The biggest single actor here is, of course, the government, who plays a crucial role throughout the economy. So let's get started. Our first speaker today in this session is Paul Mills, who will be setting the scene by providing an overview of developments in the region. Paul has been working at the IMF, Treasury, and is now an independent economist. But Paul is also a veteran when it comes to the banking academy in East Africa. This is your third session, Paul?
Just my second, but I was here last year.
The second one. Well, great. So the floor is yours.
Thank you. So I'm just going to give a brief overview of where the global economy is at the moment, what the risks entailed that may need to be hedged or considered, just to give a backdrop on what action may need to be taken. I think the bottom line is that we seems to be transitioning to a world of higher inflation. That's not necessarily hyperinflation or very high levels of inflation from the 1970s, but certainly structurally higher inflation than we've enjoyed in high-income countries for the last 30 years or so. But that's going to be combined with low or probably negative real rates, as central banks are not going to raise nominal policy rates high enough to deal with the inflation that's there. So real rates are going to be negative maybe for a decade. So what we're seeing is obviously economic activity has recovered relatively quickly in high-income countries due to unprecedented policy stimulus, both monetary policy in terms of quantitative easing, interest rates still at zero or negative in many countries, but unprecedented fiscal stimulus that has been on wartime levels, even greater than the great financial crisis of 2008, 2009. Because of that, inflation is now surprising on the upside. That's because the policy stimulus that when governments borrowed and put money into household balance sheets, that's being spent. However, that's combining with a global supply chain system that is still disrupted due to virus restrictions. and also dissuaded labor supply. So the stimulus payments, the vaccine mandates have eroded labor supply to a degree. On top of that, we're having what you could call greenflation. That is, the dissuasion of investment into fossil fuel production has meant that the high prices that we've seen recover in oil, gas, and so on, that's not going to quickly result in increased supply. So structurally, energy is going to stay high for a long time. That will then feed into higher food prices next year. As a result, short-term interest rate volatility has picked up dramatically in the last few months as markets are speculating as to when and how much central banks are going to respond to this higher inflation. We've seen that particularly in the UK, where the Bank of England seemed to give the market the impression that rates were going to be tightened earlier this month, but then backed off that. And that has led to rapid, very high short-term interest rate volatility. I think generally it's still assumed that any rate rises are going to be limited. UK, US are not going to reach even 1% policy rates until 2023 at the earliest. That means that real interest rates are going to stay negative for a long time. Central banks may wish to state they're going to try and keep inflation under control, but they cannot afford to do so because any significant increase in interest rates are going to lead to their own government debt positions becoming sort of very difficult. There's going to be fiscal dominance of monetary policy due to the high level of debt that's been accumulated. In the medium term, we've seen some unwinding of the deflationary pressures that have kept retail inflation low for a long time. Those are geopolitical tensions are leading to sort of the unwind of globalization to a degree. And as I've said, the drive to net zero and decarbonization in some countries, that's going to lead to higher commodity prices, particularly in metals, higher energy prices, and lower growth and productivity. So those are inflationary. But on the other hand, we've still got technological innovation and demographics that are going to keep a lid on price levels. So currency trends, for instance, are that certainly in high-income countries, currencies are, in a sense, much of a muchness. Most countries have had to stimulate greatly, keep interest rates low, have high fiscal stimulus helped by quantitative easing. And so effectively the big currency issues are going to be fiat currencies versus real assets, be that property, quality equities, commodities, land, and maybe even crypto and gold. So that's the sort of big macro question, fiat currencies versus real assets. At the moment, the US dollar is enjoying significant strength, even though the fundamentals of the US economy would indicate dollar weakness in terms of record trade deficit, huge fiscal stimulus, very dovish sounds out of the central bank as it focuses on reducing unemployment. But the US dollar has broken up on the upside, particularly against the euro. And that's essentially what's happening is that US assets, particularly property and high quality tech equities, are being sold to finance its trade deficit. So it's still getting capital inflows as a result. So the concern for particularly low and emerging markets, low income emerging market currencies will be that dollar strength could be very damaging in the next few months. Key issue for global macroeconomy is around China. China has been slowing quite drastically due to the various policy initiatives. We seem to be on the turn. There may be some policy stimulus coming, particularly if that leads to currency weakness. The renminbi has been strong even against the dollar over the last few months. There may be some weakening of that. If there's a turn in policy in China, that's then bullish for wider commodities. As I said, there's a lot of issues around commodities and which commodities are going to be in short supply over the next few years, particularly due to the drive for decarbonisation. So that's going to help oil producers and metal producers relative to agriculture, although we could see a pop in agricultural prices in the next 18 months or so. There is still scope for policy errors, particularly at the moment. The Turkish lira has been hit hard as a result of political interference in the policy-making process and seeking to keep monetary policy very loose for ideological and political reasons. So that's why the Turkish lira in particular has been extraordinarily weak. So just to sum up, conclusions to think about what I've got to worry about, what to hedge. We're going to see negative real rates in high-income countries and currencies for a sustained period. Structurally higher inflation, probably not sort of double-digit inflation levels from the 1970s, but certainly structurally higher inflation than we've had for some decades, combined with low growth in high-income countries. The big issue is going to be the value of real assets relative to fiat currencies. I'll leave it there. Thank you.
Thank you, Paul. This is a great overview, setting the scene for further discussion. Let me ask you one question. Has it been a textbook crisis so far? Is it unfolding as we would have believed at the beginning, or are there surprises? And if so, what are the biggest surprises so far for you, especially for Eastern Africa?
Well, the surprise for me was that countries locked down in the first place, which was a sort of unprecedented, unplanned response to this type of virus. If you'd done flu pandemic planning before, this was definitely not what you'd have recommended to policymakers. Then, having done that, the policy response has been sort of unprecedented in the sense of fiscal interventions, loan guarantees, and so on have been novel, and in many countries have helped economic recovery from a very sharp contraction of economic activity. So in that sense, that's been a surprise. Having done that, the recovery has, say in the UK, has surprised a little bit on the upside, and that's helped with government borrowing. It hasn't been quite as high as expected, but because of having quantitative easing in the toolkit, governments took those unprecedented economic measures. So in a sense, that central bank intervention gave governments the confidence to persist with lockdowns when they might otherwise have chosen not to. So the concerns obviously affecting East Africa and elsewhere is that there was obviously sharp contraction in the external environment, and that led to loss of confidence and reduction in economic activity. Perhaps the surprise has been dollar strength over the last 6 months, given the dovishness of the Fed, the vast fiscal stimulus that's occurred in the US. And so that's been the shock, I think, of the last few months.
Thanks, both. Really interesting, and I think everyone will recognize a lot of the points you mentioned here. You mentioned higher inflation several times, that it's here to stay with us, and the impact on FX rates. We also have Isabelle Lessedjina on the panel. She's a senior vice president of TCX, and she's an expert on these exchange rates. Isabelle, the floor is yours.
Thank you, Sanne. Good afternoon, everybody. Thank you for inviting TCX to speak at this event. I'm going to make a short presentation about what we see in general in terms of currency and what we see, especially currency linked to the COVID crisis. So yes. Just to establish a bit TCX, TCX is a fund that is established in 2007 exactly for that, to provide currency risk solution when there are none. It was based on a few principles, and the idea was to provide edge with no tenor limits, participate to capital market development, and trying to de-risk this situation. And it was based on a few principles really that we see is that usually in emerging and frontier market, currency tends to depreciate. If you look at the depreciation of some of the currency for the past 20, 30 years, you see that usually the orange lines show that the currency tends to depreciate in general. More so, if you look at Sub-Saharan Africa and you look at the depreciation for the past decades, you see kind of the depreciation going from in the 30s to more than 100%. And I think I put most of the East Africa currency there. So that was a bit the idea is that if you receive, and most of the country in Sub-Saharan Africa, especially have the external debt or borrow at the macro and the micro level, borrow mostly in hard currency, dollar and euro. So on top of having to reimburse the debt, they have to account for the depreciation, which can have an impact on their performing loans and the ability to reimburse. And so the idea was, let's provide a solution and try to develop this kind of solution for the future. And then COVID happened. And COVID kind of is the mother of all crises. And we realized that on top of that, when the country is already has a high level of hard currency debt and is already in kind of a moderate growth, and you add a crisis such as COVID, create a shock, the exchange rate is actually increase exponentially the shock. And you see that most of the impact on the debt end up being linked to the depreciation. When you look at, there is a study on debt stability done by Ugo Panizza from Geneva and Stefano Pranelli from Johns Hopkins, that show that kind of, I think 20% or more of the debt crisis or the debt can be explained usually by currency at the time of shocks. So the sensitivity to external shock is quite high. And you see that at the height of COVID, that's not even cumulated, at the height of COVID, you see some of the depreciation of this country going from 5 to 10% in March. At that time, our fund had a unrealized loss of more than $130 million, and we are only a drop in the ocean of currency risk. Really a drop that shows that how during the months, suddenly a crisis can have such a big impact. So for us, it's kind of important that to see what is happening at the sector, at the macro level, but also within the financial sectors. We see more and more now that people are looking at solution to hedge themselves, being a natural hedge or finding a solution to hedge their exposure. We see more and more awareness in some countries like Kenya or Nigeria on the importance of debt sustainability and the link with debt. And we hope that in the future, within the financial sector, the microfinance sector already had the reckoning on currency risk and understanding the impact of lending to the poorest in dollar-based or dollar index. But I think other sectors were struggling a bit more. I think that COVID kind of, with all these shocks, showed the importance of not only in the debt sustainability discussion, not only talk about the level of debt, but also talking about the type of debt in terms of interest rate, currency risk, and all that, and finding the right balance in de-risking to make sure that these debt are actually sustainable.
Thank you, Isabelle. You mentioned March 2020, and I went back to what TCX was writing at the time, and they say you basically said that this is a script that is improbable for Hollywood, which is currently unfolding. I can imagine that those days at the TCX headquarters in Amsterdam would have been quite exciting, no? Perhaps even you were in panic mode because this kind of events could potentially wipe out your equity. Could you tell a bit more about how you went through these first days of the crisis when the impact on exchange rate was still unsure, or the size of the impact?
I don't think we were really in panic. I think we kind of took the time to reflect a bit on how to react. So we, in a way of, for example, on the pricing side, we took time to, on pricing, we increased a bit the range of our pricing to observe. But we are a impact-driven organization. So for us, it was kind of more about trying to talk to our shareholder and their customer and trying to find a way to give them solution. We did a lot of restructuring of some of the pricing we were provided. We did a lot of pricing on converting some former debt that were in hard currency in local currency. We try to advocate quite heavily on saying that the situation, it's a global crisis, but this crisis will be worse for emerging and frontier market because of the currency risk. So we did a lot of advocacy at that time. And actually, our CEO wrote an op-ed about that, saying that we lost more than 130 billion. It was unrealized. Since then, we kind of rebalanced the situation, but it shows how strong the fund is in terms of capitalization. And also it shows that we serve a purpose. We lost for the poorest and the more fragile not to lose. So if everybody kind of, if this drop in the ocean could become let's say a lake or even a river, that would be just already a big impact in the whole frontier market.
Yes, TCX functioned there as it was designed to function, by supporting the companies that could not bear the FX risk, and TCX has survived. So far so good. You mentioned earlier on before this session that TCX is working together with the IMF on a survey. Could you tell a little bit more about that?
No, yes, for sure. But when you look at financing project in renewable energy or MSMEs, you realize that if you do not find a solution at the macroeconomic level, the impact is still a bit limited. So we've been collaborating with IMF that issue a survey around 120 countries for their treasury and their DMO offices, asking them questions about how they manage currency risk. Is it a problem for them? How do they manage that? Do they hedge naturally? Do they use derivatives? Do they have enough training, support, infrastructure to be able to manage that? And based on that survey, we hope that there will be the opportunity to analyze the data and build a solution in terms of training or product that will fit and allow these Treasury and DMO department to have the best solution that fits their need. But at least when you look at a path from frontier to emerging market or even high economy, when you look at the level of debt between hard currency debt and local currency debt, developed economy or high economy and emerging market economy have a higher ratio in their own currency and that participate in the stability. And we think that it should be the same for frontier market.
Wonderful, thank you. And when do you think that the results of your collaboration with IMF will be available?
Normally at the end of the year. The result of the survey should be out at the end of the year.
I'm already looking forward to it. Thank you, Isabelle.
Thank you.
So our next speaker is Tom Lawton from TLT Training. His focus is on trade finance and credit risk commodities. Tom, perhaps you might want to touch a bit more on the external risk, FX risk, but it would be great if we could also start looking a bit more into the domestic risks. And especially the changing creditworthiness of many of the actors inside the economies. The floor is yours.
Thank you very much, Sanne, and thank you for inviting me to TDB EIB for the 4th year. Just a quick background, I am at the lower end of the scale, dealing with the on the grounds, looking at people in the SME sector and the MSMEs, and the impacts and how they can manage their risks as they go through. I'm working with banks. I've been working with banks in East Africa for 32 years. It's a long time. I never thought I'd ever see what I saw with COVID, even though I had to escape from Uganda on the last flight out because of it. The challenges that are being faced is that the management of currency risk, in fact, risk at the lower level, hasn't been touched upon very often. Forward contracts to anybody in a developed market were just second nature. You open a letter of credit, you open a forward, so you know what your currency cost is. It's never really been there except in the corporates. I was talking to a head of treasury of a bank in East Africa recently about this, and they have a minimum trade of $250,000, which is crazy. They are an MSME bank. They are not a corporate bank, but there's no options available, which would be perfect for the MSME sector. But the impact overall isn't just a currency risk, although in the Kenyan marketplace, it hasn't been for a number of years with the US dollar, because for 4 years it was between 100, 103 to the US dollar. It's hit today the lowest ever at 112, whilst we've been in the conference. Again, it's when we talk about currency in the East African market, I look at the flows. It's simple, flow in, flow out. And during COVID, if you've got shutdown of your export marketplace, you've got shutdown of your tourism coming in across the region, your currency has to go. There's no way you can do anything else. But add to that, if you have foreign currency debt, which every country across the continent has, they then run into difficulties. But that cascades down. If the country's in trouble, the corporates are in trouble, the suppliers to the corporates are in trouble, and that includes employees. Those employees won't have the money to spend that they have before. It just cascades through the whole economy. And I think the number that I dug out earlier, on microfinance banks in Kenya, they had losses in 2019, and I'll put it in euro terms roughly, of 3 million euros, the top 14 microfinance banks. By the end of 2020, it is now 18 million euros. And the CEO of a microfinance institution, when I WhatsApped him, wouldn't tell me his NPLs other than the NPLs were greater than his performing loans, because it's gone down through the whole sector, and that will have happened in every country. I know from presentations yesterday, hearing about Zimbabwe, Malawi, the challenges that they have been facing, and Uganda facing the challenges for the first time in a very long time. Rwanda's depreciation of currency, it goes all the way down. We think that currency just affects the high end. It doesn't. Your cost of food goes up, your cost of transport goes up. The work isn't there. So you have an economy that is hit. Now, when do we come out of it? Or even answering Jamaluddin's, should the EA have done differently? I think a lot of the financial institutions did exactly right, because they had no history to go on. I mean, this was nowhere near as nice as the credit crunch of 2008, 2009. This was something we've never seen. The only place we could perhaps have used to benchmark against was Sierra Leone and West Africa with the Ebola crisis. But that was a much narrower crisis to what we're facing today. Where does it go? Very difficult to say. The Central Bank of Kenya announced recently that they are stopping listing on the credit bureau defaulters up to the value of 5 million Kenyan shillings, which is the micros. So they're doing that, I think, to protect the micro industry, because if everybody is listed, that's it. The microfinance institutions are in dire straits. I sound very gloomy, don't I? But it's something I've never seen. Yeah, I've 47 years in this industry, 65 years on this planet. It's crazy. And uncertainty is not the mother of all evils, it's the Satan of all evils. Yes.
Yeah, no, I think your point is very clear, no, that the risks are sipping through and are ultimately showing up everywhere in the economy and throughout. Anthony is our fourth speaker. He's from ABSA Asset Management, and he will tell us more also about the financial industry, asset management, allocations of money during the last 2 years. Anthony, the floor is yours.
Thank you, Sanne. Yeah, it's a pleasure to be here. Yeah, so as Sanne says, I'm an asset manager within the region for the last 21 years. And I just wanted to highlight, next slide, please. I wanted to highlight what has happened in the last 2 years, during COVID and quote unquote, post-COVID, how longer holders of longer funds have allocated or have changed the allocation of funds and for various reasons. In general, within East Africa, the allocators of long-term capital are either asset managers or insurance companies, and to some extent banks, but mostly asset management or insurance companies, which are managing, of course, life. Around 73% of that money to fixed income securities, to a large extent government bonds. And then we're also doing close to 3/4 of their monies and very little on real estate. And of course, around a fifth of asset managers were allocating to the available East African exchanges listed equities. So if you see there's been very little allocation to international assets or offshore investments, purely for two reasons. One, as you've realized, the dollar against the East African currencies has been strong for the last almost 7 to 9 years now. And for that reason, it's been quote unquote expensive to allocate money out. And there's been more of bringing money back because you make currency gains. Fast forward, next slide, which is 2021. You realize there's no much change. The bigger change, we see it with the insurance sector, which has had an increasing bias to allocating to fixed income securities, specifically government bonds, and that's mainly because they have gone light a bit on real estate, and part of it is actually a revaluation change, and then asset managers managing insurance fund, managing pension funds You realized offshore has almost gotten muted. Again, a few volatility of local currencies to international currencies, and secondly, again, as I said earlier, I mean, the local units or currencies weakening against major currencies like the dollar or the euro. And then there's been a bit of inactivity in the listed equities market, and therefore not much has changed. So if you ask me, has the COVID or long-term allocators of capital have behaved before COVID, during COVID, and now, if I assume heading towards post-COVID? Not a major change, but there's still a strong bias of flight to safety, as you can see it. Because of time, I think I'll stop there so that we can pick a few questions from the audience. Thank you, and back to you, Sanne.
Thank you, Anthony. Before going to the question of Armando Massimiliano Cirola, let me just ask you a question. Is this it when it comes to the impact on asset allocation, or do you expect some more shifts in the coming period? Anthony?
Yes, I mean, no, it is still a fixed income government return of activity of the equities market through one or two IPOs. And if the currencies strengthen locally, we might see a bit of return of allocation to international assets, but no major change of this allocation for long-term funds by these two key three players.
Okay, that's a very clear answer. Thank you. Tom, could you answer the question raised?
Armando, I should ask Armando to answer it. From his previous history, he was within this banking sector. So he was not providing when he should have, perhaps. Armando, good to hear from you again. Jambo Buona. There's always been this challenge. Are NPLs real? Aren't they real? That comes down to central bank governance as much as anything. Yeah, are the central bank audits doing what they should? If you've got the real estate sector, for example, and you have the COVID situation, yeah, it's stopped in marketplaces. And there are many examples of things are hidden in there, but we hide behind this valuation of property as our way out. But as I always say to anybody, until you sell it, it's worthless. Yeah, nothing's worth anything until you've sold it. And again, I think the way that we're looking at the provisioning process in the commercial banking sector has flaws. And I think until somebody actually addresses that, I don't think IFRS 9 has addressed it correctly, then we're always going to be able to hide behind it. The Economist, though, would hate my next statement. What we need is a good dose of inflation to put up the value of property to be able to sell it at a higher price and get out. But on a realistic situation, until central banks perhaps govern their NPL situation on a much tougher being, we're never going to get a true situation.
Thank you. I'm mindful of time, so let me conclude with a positive and a slightly more pessimistic comment. The positive being that it seems that so far the risks ended up at the people, institutions, agencies that are best suited to bear them, instead of at those people or those institutions that are least able to understand the risks. So that is very positive. I also note that a lot of the speakers are talking about risks in the future tense, And together with the fact that buffers have been depleted in the last 1.5 years, well, I suppose that we might have another session on risks next year in the next East African Banking Academy. Thank you very much.